What's going on? It's your boy Aristotle Investments, and we back with another special video presented by Honey Drip Network. All right, so in this video I'm going to show you how I turned 100,000 and then I made 400k in a Robinhood account. So yes, 300k profit. All right, so it took a little over a year to make this, but I'm going to show you guys exactly how I did it and the 7 lessons I learned in order to make this money. All right, so I'm going to show you in a live account, because you know some people be like, hey, that's cap. So I'm going to show you it ain't cap. Let's get it. So as you can see, I was up 300k in this Robinhood account. Now it dropped down 10k because of a bad market day, but here's proof, folks. So check me out. I'm going to show you some gains here. I'm gonna scroll down. These are all the leaps that I entered, and you saw me enter them in the group chat. So boom, we start with Apple first, and as you can see, I'm up 162%. Go to the net stock. Go to Google, 104%. So I'm just banking on these shop, 332%, 35k. Nvidia, 65k, 840%. And I even took profits, 50k before. So yeah, I'm really up over 100 racks. AMD, same thing, 287%, 29k, almost 30k. Meta, up 86,000, 845%. It gets no better. The number one thing I learned is to always wait for a market-wide crash in order to enter either a long-term position or a leap position. The reason I say this is because you always want to buy low and sell high. Now, you do not want to chase when everyone is trying to get into a stock when it rips. You never want to buy the rip. You always want to buy the dip. Now, I know what you're thinking. Well, Aristotle, what if that dip never happens? You have to trust that the dip will come one day. It may be every 3 years, it may be every 2, but you have to wait on it. So I'm going to show you some key factors to look for so that you can see whether the market dip or not. All right, so stay tuned and watch this. So first things first is you want to head over to the TradingView application or the web page, and you want to type in the ticker symbol SPY, SPY, and you want to go to the daily chart. Okay, so right here you would type in SPY right here, and then you would go to the 1-day chart. All right, so you can either look at the weekly or the daily. So I want to look at the daily. Next, you need to know what is a bear market. As you can see, a bear market is defined as a prolonged period of investment prices that drop, and it is a 20% decline, right, from the most recent highs. So check me out, 20% decline from the most recent highs. So how do you figure out whether something has done a 20% decline from the most recent highs? Right here. You go to this line right here, and you go to info line. You go from the top all the way down, wherever it dropped. As you can see, when it dropped right here, you see we have a negative 24% decline. So that's the info. Bring it down some more. So boom, negative 27%. So negative 20% was roughly right here, right? Along this line at the 382. So this is the most recent high, the 480-ish, right? That was the 50, well, it's not the 52 high anymore, but it was all-time highs, right, at that time. So when I invested in these leaps, I waited at least for a 20% decrease. So you want to definitely wait for a bear market. Never see how close you can get with 20%, and then you average down from there, and we'll talk about that later. But yes, first I need to see a 20% decline from the most recent highs. So if you guys want to put that into perspective, this was the COVID-19 drop right here. And if we take this info line, let's see what decline that was. Nearly a 35%, okay? And this was, what is this, 2018? This was the trade war decline. And let's see what that was. This was the most recent high at that time. 20% bear market. So as you see a pattern here, it's all in that 20 to 40% range in which you're averaging into a long position from the most recent highs. So that's key number one, just something that simple of drawing these info lines and seeing this number right here, negative 35%, negative 20% during the trade war. So it's time to start averaging in around the 20% decline mark from the most recent highs. So that means this is SPY, SPY, and they are ETF, and they are comprised of a lot. So if you Google Zach Holdings, so SPY Holdings by Zach, so you go here, as you can see, this is the S&P 500. Let's go here one more time, there we go, SPY Holdings. So when you go to Zacks.com one more time, click here, and it takes you right here, and boom, you see that they own shares. This is the S&P 500. They're comprised of 500 of the world's top companies. Okay, so you'll see what they're investing in. As you can see, they have Apple as their top stock, Microsoft, Amazon, Nvidia, Google. So basically, these guys move the market. All right, the S&P 500, Standard & Poor's 500. Okay, so that's step number one. We need a prolonged period of decreased prices. Okay, we always need to wait for a market-wide crash or dip. The number two method is to scale in. Okay, so you need to scale in. Never go full size on the first drop. So yes, during that 20%, let's just say you have $10,000 that you're trying to start a long-term portfolio with. 5,000, 50% goes into the stocks you want to buy at the 20% mark. That's what I recommend, 50%. And then you pretty much divide it down from there and average in to your positions from there. So that's the way I would recommend. I showed you guys how to get the 20% mark downward. Now, as soon as that mark happens, that's where you go in 50% size. You never go in full size. And then towards the 40% mark is where you go in all, the rest of the 50%. But you would scale in from there. So let me show you what I'm talking about. So this is the stock ticker symbol SPY, SPY. Remember, right here, 20% mark, we scale in at least 50% of our size. And then I would say every 10%, you put in more money. So maybe another 2,000 to 30%. And then at 40%, we go on another 2,000. So now we're 9,000 deep in and we got 1,000 left. You get what I mean? So that's how you kind of got to scale in. Another thing is, like, let's just say stocks like Tesla. From the most recent high, it did an even crazier drop. So we take this info line. This is the most recent high, or the most all-time high. And this drop was nearly 74%, right? So that's just for the market, for the bear market. I'm looking at SPY for the 20%. Now for other stocks, that could be, it could be stuff like this. Like I've seen people lose nearly 100%. I think it was Meta. From their high, they nearly lost. Look at that. They went from 382 to, like 80%, right? Like these things be losing a lot. So when it comes to stuff like this, I'm letting it drop. So when Meta just kept dropping, of course, a lot of shorts lost money, but I literally waited for all stocks to get to a point where they could not drop any further. And you might have to average in these. Now, that's for the market where you know how to average in or see where the dip should be bought. But for stocks like this, you would want to wait. Okay, so whenever there's a bear market, whenever the market reaches below 20%, you need to wait until this thing is depleted, because stocks will deplete. Stocks will keep falling. And because I know that I have to average in these things. So let's just say Meta, right? You're trying to secure the dip, right? I would honestly say for stocks other than S&P 500, I would start investing around the 50% mark. If I had to be honest with you, around the 50% mark is where you should be investing after a 50% decline from the most recent high. So let's see, Nvidia. I would say start scaling in. Yeah, because like think about it. If you get in at the 50, you're not too far from the bottom and you can average in from there. So let's just say this is 50% right here. Hold up. Let me delete this. See that? So go right here, start right here, and then we're near the 50 where it started, right? So around this time, if we would have bought the dip from a 50% decline, we would be buying in 50% of our position here. And then I would say every 10% drop, add the rest into your position. So I would say that would be a good rule of thumb. 50% from decline from the most recent high. Well, the highest point really. So this is the highest point. Take our info line, go down 50%. So think about that. You can average in from there. So with the S&P 500, it's 20%. But with stocks like this, I would recommend at least a 50%. And it looks good from there. Because if we average in every 10%, so we go down 60%, put in more money, we're near the bottom. We go down 70%-ish almost. So yeah, 50%, put in most of your money. All right, so that is how you average in. You want to scale in thirds or fourths. So that's what I would recommend. That's a rule of thumb. Scale in thirds, but put the most amount during the 50% mark. And then I already told you what to do with the market. Okay, so we're gonna talk about more. Let's get it. So the number 3 lesson I learned is to always buy when people are fearful and to sell when they are extremely greedy. So I'm going to break down how you need to do this. This is called the Fear and Greed Index, and you have to go to CNN.com. That's exactly what we're about to do. So you would Google Fear and Greed Index or indicator, and here it goes, Fear and Greed Index, CNN.com. You go right here. Now you see we are greedy, but we are not extremely greedy. Remember, I like to buy at extreme fear, and I like to at least start selling at extreme greed. So luckily, they're giving us indicators to use to figure out when to buy and when to sell these stocks. By the way, if you want to figure out when I'm buying and selling my stocks, look no further than the world's best trading and investing Discord, Honey Drip Network. So let me break down exactly where I told people that I would even enter all of these leaps, okay? So right here, inside of my Discord, as you can see, this was 9/28/2022. I said I'm getting into AMD, Google, NVIDIA shop. By the way, I'm up on all of these. And then I said I'm adding SQ and Meta, okay? So I literally broke down, as you can see right here, the exact positions I'm in. So I'm up well over 6 figures in NVIDIA, a lot on Meta. I bought the dip on all of these, okay? And look when I bought, around 9/28, okay? And then I'm giving you progress on all of the leaps I bought verbatim, okay? I'm even showing you we're up 18K already. Boom, 23,000. I'm showing them 46K. So I'm showing you from scratch as I build this account. 100,000 made, 6 figures. See that? And we could just keep going. I'm giving them progress the entire time. 200K made. See that? Boom. 1 year, 278K made. And I grew this account all the way to 400 racks. Okay? So you don't want to miss this. And I even show progress. See that? 78K on Meta. I made way more. Now, NVIDIA, all of these are up. And then boom, 280K. 294K. So, and then it ended up getting over 300,000. But yes, there you go, folks. I literally showed them from scratch how to grow an account from 100K to 400K and I literally told them exactly what I'm buying and selling. So if you are interested in getting my plays during the next market crash or our day trading, so you want to make money now, click the link in the description and I'll get you in. And for you guys, I'll give you guys $10 off on the trial. Come try us for $25. All right. It's your boy Aristotle Investments. Now let's get back into these lessons. Now, the number 4 lesson that I've learned is to use separate accounts for each trading style. Okay. So you need a day trading account. You need a swing trading account. You need a long-term account, and you need a leap account. So let me explain all 4. Day trading is buying or selling a stock or an option play in one day. So the stock market is open from 9:30 a.m. Eastern time to 4 p.m. Eastern time, the U.S. stock market, okay? So yes, the stock market runs off New York time. Now, what you need to do is you need to separate all 4 accounts. So swing trading account, that is buying a stock or an option play, and you're literally holding it overnight, weeks, months, or years. Okay, so that's what I did. I did option swings. So you need a swing account, and a swing account is holding stocks overnight, so past the 4 p.m. mark. So whether you're doing buying shares, whether you're trading options, you're holding it overnight, and that could be for a day, a week, a month, a year, right? But for swings, we usually are doing these short dated, okay? So they are usually weeks to months, okay? So that's a swing account. That's your second account. The third account, of course, is the long term, buying shares, and that should be your largest account. You should be buying a lot of stocks and using a bulk of your money to invest in shares, okay? And then you have your leaps. Those are year to 2 year to 3 year out option swing. I specialize in all 4. I love doing all 4, and I recommend you try all 4. But if you do, always separate accounts, because each has a different psychology and mentality and risk management. With long-term plays, you are buying shares and you are using all of your money in buying stocks. So if you got $1 million, you shouldn't have too much money left over. You should have about 800 invest in the stocks and maybe 200 to buy another dip or something like that. So you got 10,000, 8,000 goes into all shares, diversifying your portfolio. Okay, if you're doing swings, that's a different risk management and psychology. You're supposed to go light, especially if it's not very long dating. You don't plan on holding for 2 to 3 years because you got expiration dates or whatnot in day trades. Okay, that is using a more size less trades method, if that makes sense. So like I said, separate all accounts. That taught me a lot. And with this particular account, to make 300,000, this is a leap account. All right, these are called leaps, long dated option plays, right? So I recommend putting it in a separate account. Set and forget. Do not put it in your day trading, swing, or long-term account. And if any account, put it in your long-term. Still, don't do it. And leaps are play money, okay? Leaps are play money, meaning if you have 100 racks, maybe 5,000 goes into leaps. 5% of your money should go into leaps. So that should tell you what 100K is to me. All right, let's get into the next lesson. The number 5 thing to do is to practice extreme patience. So a lot of you want to get rich overnight. It took me 1 year to make 300K. So that is fast money to me. That to you guys, that's slow, but to me it's fast, because I guarantee if you're watching this, you probably didn't make 300,000 last year. So am I making slow money, or are you making slow money? So remember, folks, the slow route is actually the fast route. If you wait, if you look at something over a larger period of time, you'll make money faster. But if you're always trying to make quick money, you're always going to lose money. So I always think of things long term, and it makes me a lot of money. Okay, I'm telling you the truth. So yes, practice extreme patience. Now I know what you're asking me, Aristotle, how do I practice patience? Wait. Trust in your analysis. I just gave you guys the game on how to see whether the market dips, the fear and greed index, all these other things. And if you want to learn more, of course, sign up for the mentorship. All right, it'll be another link in the description. But yes, patience is key, okay? The tortoise wins the race. The number 6 thing to do is to trust your analysis, okay? So if you were to hypothetically take a lot of training from me or even follow the advice I gave in this video, okay? To know when to buy, when to sell, take your leaps, trust your analysis, do not exit even if you're down. And even like I said, leaps should be play money in the first place. So if this is play money, if this is house money, think about it. I'm only playing what I'm willing to lose 100% of. So if you're thinking to yourself, okay, I'm going to mess up 5,000 on designer this year, but I could give that up for leaps and turn that 5 into 15 or 20. You know, you can double, triple, quadruple your money with these, right? So that's how I see it in that way. Why not use the play money to invest? You get what I'm saying? So I can be patient and trust my analysis in the first place. I'm playing with house money. Number 7, and that is to not listen to gurus on Twitter, okay? I'm telling you the truth. These guys say a lot of bull crap when the market dips. They're telling you it's going to zero. They're telling you the world is going to end because they're listening to the news and everybody wants to be right. Everybody wants to be the guy who shorted the housing crash. I don't know if it was Michael Burry or whoever it was who shorted that. Everybody's trying to be that guy. The Warren Buffett, the whatever, right? They want to be the guy to say, look at this tweet. I was right. The market went to zero. The world went to an end. So what they do is they build a following and then their community listens to them so they don't buy the dip. And now they've missed out and they like, dang, I was so scared because I trusted in this expert who pretended to be a guru. Like, it's very toxic. It really is. It's extremely toxic. And I personally would tell you to just follow the advice I gave you and to do your own research, of course. Now, I'm not saying trust in me and don't trust anybody else, but I'm showing you proof of what I did. I don't trust what they say. I buy the dip. Remember, buy when they're fearful. There's an extreme fear indicator and greed indicator for a reason. And if you listen to Twitter, they're going to tell you to be extremely fear. All right, they're going to tell you to be extremely fearful. And I don't agree with fear mongering. The news does it. While the billionaires buy the dip, they're telling you to be scared, okay? Because they're not going to tell you until months later that, hey, I bought the dip. So I'm telling you the truth. Because you don't have inside trading, you should be buying like I told you to. You should be averaging in, or else you're going to be in a repeat cycle of listening to all these theories from these gurus telling you that the world is going to fall apart. It's your boy Aristotle. Please like, share, subscribe. I'm just here to give you guys value and to help you get money. It's free. It is what it is. Y'all know what it is. The best.